On May 27, 2026, the man who runs the company that owns the New York Stock Exchange stood up at a Bernstein conference and called a crypto exchange bigger than NASDAQ. His exact words? Quote, "If you haven't heard about it, it's bigger than NASDAQ, okay? It's 11 people." And in the space of just a few weeks, Goldman Sachs, Andreessen Horowitz, Grayscale, and 2 separate spot ETFs have all piled into the exact same asset. 18 months ago, this was a crypto-native exchange that most of Wall Street had never heard of. Today, it's a top 10 cryptocurrency trading at an all-time high of around $74, up roughly 199% year to date. The truly extraordinary part here is the timing, because all of this big money is FOMOing in just days before roughly $714 million worth of insider tokens unlock onto the open market. So today, we'll lay out exactly who has arrived and why, dismantle the one engine that everyone is bullish on, and show you the supply cliff that the smart money is buying directly into. My name is Lewis, and you're watching The Coin Bureau. Now, before we get into whether this is genius or greed, you need to understand what these institutions are actually buying. Hyperliquid is a decentralized exchange built on its own Layer 1 blockchain, and its specialty is perpetual futures trading. Put simply, it's a crypto derivatives venue that feels as fast as a centralized exchange, but settles on-chain where every position is visible. And the numbers underneath it are genuinely serious. In 2025, Hyperliquid did around $800 million in revenue. It processed roughly $2.9 trillion in perpetual futures volume. And it commands over 70% of all decentralized perpetual open interest. Unlike typical crypto speculation, this is a real business generating actual cash flow, which is precisely why the establishment suddenly cares. So let's start with the stampede itself, because the scale of it is the part that demands an explanation. In mid-May, 2 spot Hype ETFs went live. 21 Shares launched THYP on the 11th, and Bitwise launched BHYP on the 14th. And these things did not crawl out of the gate. Within roughly 13 trading sessions, they pulled in over $136 million in cumulative net inflows. Now, to put that into context, here's the stat that should make you sit up. In their first 10 days, these ETFs absorbed around 1.04% of Hype's entire market cap. Compare that to the early ETFs of the giants. Bitcoin ETFs absorbed 0.59% in their first 10 days. Ethereum managed 0.41%. Solana just 0.31%. So, on a size-adjusted basis, the Hype ETFs penetrated nearly 3.5 times faster than Solana did. One Bitwise analyst called it the best single-asset crypto ETP launch since Bitcoin itself. And Grayscale isn't sitting this one out either. Their staking ETF, HypeG, has filed multiple amendments with the SEC, undercutting everyone on fees at 0.29%, with a seed plan worth roughly $130 million. Then there's Goldman Sachs. In its Q1 13F filing, Goldman disclosed a stake in the NASDAQ-listed Treasury vehicle. Now, the position itself is small, roughly around $3.3 million, but here is the signal that matters. In the very same quarter, Goldman fully liquidated its XRP ETF holdings, fully liquidated its Solana ETF holdings, and cut its Ethereum exposure by 70%. Frankly, that's a full-blown rotation. And finally, the venture giants. On-chain analysts at Look On-Chain and Arkham have linked a cluster of wallets to Andreessen Horowitz that accumulated roughly 3.9 million Hype since mid-April, worth around $192 million. Now, I have to flag that A16Z hasn't publicly confirmed those wallets, so treat that as attribution, not gospel. But at least one of those wallets is staking, which signals a long-term hold rather than a quick flip. So that's the establishment arriving all at once. The single most aggressive bet here comes from a completely different player, a publicly traded company. Trading on NASDAQ under the ticker PURR, Hyperliquid Strategies is, quite simply, the MicroStrategy playbook pointed straight at Hype. And the origin story tells you everything. This company was born from a reverse merger, where a former biotech firm called Sonnet Biotherapeutics was essentially hollowed out, and repurposed as a Hype treasury vehicle in December of 2025. Today, it holds 20 million Hype tokens plus around $103 million in cash. It carries a market cap of about $1.46 billion. And running the board is Bob Diamond, the former CEO of Barclays. When the man who once ran one of the world's largest investment banks shows up on your crypto treasury board, the establishment has officially arrived. In Q1, the company posted net income of $152.5 million. That sounds spectacular. But here is the part the headline conveniently leaves out. That profit is almost entirely unrealized mark-to-market gains on its Hype holdings. And if you zoom out to the full 9-month period ending March 31st, the company actually posted a net loss of $165.4 million. So this knife cuts both ways. When Hype goes up, the paper gains look incredible. When Hype falls, those gains vaporize instantly. You might assume that's just a quirky accounting story with no real market impact. However, that assumption ignores what happens on June 26th, because on that date, PURR joins the Russell 3000 index. And index inclusion triggers mechanical, forced buying from passive funds that track that index. These funds don't care about price, valuation, or unlock schedules. They simply have to buy. So, this manufactures a structural bid underneath the stock, but it also chains Hype's fate to a leveraged treasury vehicle, the exact same model we have watched amplify gains on the way up and accelerated pain on the way down. So, let's be fair to the bull case for a moment, because the fundamentals genuinely justify some of this. The real engine here is the buyback. Roughly 97 to 99% of all platform trading fees are routed into an automated fund that continuously buys Hype on the open market. Put simply, the more people trade, the more Hype gets bought and removed from circulation. That mechanism removes an estimated 14% of circulating supply every single year. To date, it has executed over $1.3 billion in cumulative buybacks. That is a genuine cash machine. Bitwise's CIO has gone as far as framing Hyperliquid as a, quote, super app targeting the $600 trillion global asset market. Arthur Hayes calls Hype a generational asset with a $150 price target. So, the bull case is not stupid. It's real. But that very engine everyone is in love with is also the hidden risk that almost nobody is pricing in. And before we get into that, if you want to track this unlock and these institutional flows as they actually happen, jump into the Coin Bureau Telegram channel. That's where we share breaking news, on-chain alpha, and the market updates that matter the second they land. The link is down in the description down below, or just scan the QR code that's on the screen. Okay, so let's get back to it, because this is the part that flips the entire narrative. That beloved buyback engine is 100% volume dependent. Every dollar of buying comes from trading fees. So in a bull market, it's a beautiful flywheel. More volume means more fees, which means more buybacks, which pushes the price higher, which attracts more traders. But here is the brutal reality. That flywheel runs in reverse just as easily. And the data already shows it turning. In Q3 2025, buybacks hit $316.76 million. By Q4, they fell to $255 million. And by Q1 2026, they dropped again to just $192.25 million. That's a decline of roughly 39% in 2 quarters, while the price was climbing to all-time highs. So the exact mechanism that everyone is bullish on is the first thing to break when the cycle turns. Less volume, fewer buybacks, falling price, less interest, even less volume. Now stacked timing on top of that. Around June 6, approximately 9.92 million Hype tokens unlock. At current prices, that's roughly $714 million hitting the market. And those tokens go primarily to core contributors, which is the polite term for the team and insiders. And here's the math that should worry you. At the Q1 buyback rate of about $2.14 million per day, that single unlock represents more than 10 months of total buyback capacity. The engine cannot mechanically absorb that supply. So the question writes itself. Are these institutions the smart money spotting the future early? Or are they providing exit liquidity for insiders at a known dated supply cliff? Furthermore, the supply fragility is compounded by the fact that the newest corners of this platform have already proven that they could snap. On May 28th, the synthetic SpaceX perpetual crashed 45% in around 30 minutes. It fell from roughly $2,277 to $1,254. The cause? A botched off-chain Oracle feed from a provider called Notice.co that mishandled SpaceX's 541 stock split, feeding the post-split price without adjusting for it. The result was 405 users liquidated across 1,393 positions. And this matters because of where the platform is going. These are HIP-3 markets, the third-party built perpetuals on things like pre-IPO companies and 24/7 commodities. They now account for around 40% of total platform volume. So, as Hyperliquid pushes deeper into these exotic, Oracle-dependent markets, that kind of break scales right alongside the money pouring in. Then there's the governance problem. Kyle Samani of Multicoin Capital has publicly labeled Hyperliquid Binance 2.0. The network runs on roughly 27 to 30 validators, which is a tiny set for a platform processing trillions of dollars. And critically, its core software is closed source. Now, here's the genuinely awkward part. Even Grayscale, in its own bullish report, flagged the closed source core as a risk to auditability and warned about the lack of discretionary circuit breakers in the liquidation engine. So, the same institution filing to launch an ETF is also documenting the structural weakness in writing. And of course, we should absolutely trust that Jeff Sprecker's glowing bigger than NASDAQ praise reflects pure admiration, right? Because behind the scenes, his company, ICE, alongside CME, is actively lobbying the CFTC against Hyperliquid. They want its perpetuals classified as swaps under Dodd-Frank, arguing manipulation risk and sanctions concerns, publicly praising it while privately fighting it. That tells you exactly how threatened the incumbents really are. So, here's where I land on all of this. Most coverage frames this as a simple binary: smart money in, retail too late. But the honest read is far more uncomfortable than that. A big chunk of late May's price explosion was driven by pure mechanics rather than actual market conviction. Roughly 56% of open interest was positioned short heading into the rally. When the price ripped, over $20 million in shorts got liquidated in a single day, and total short liquidations since around May 20th topped $126 million. So, a meaningful slice of this, quote, FOMO is just a short squeeze forcing any bears to buy back at any price. That's not the same thing as institutions building generational conviction. And this is the structural truth underneath the whole story. Hyperliquid is a genuine cash machine wrapped around a bull market-only engine. While the revenue and market dominance are undeniable, the reflexivity is just as dangerous. The unlock is dated, and the Oracle risk just demonstrated itself live. The smart money is buying the best fundamentals in DeFi at the exact moment those fundamentals are most exposed. So for you, the practical implications are specific. First, watch the quarterly buyback figure above all else. It dropped from 316 million to 192 million while the price rose. If that number keeps falling, the flywheel is already running in reverse, regardless of what the chart says. Second, watch what happens around the June 6th unlock and how that 714 million in insider supply actually behaves. Third, watch PER's premium to the value of its underlying hype. That premium is the engine of the whole treasury model, and when it compresses, the leverage stops working upward and starts working downward. Fourth, watch the RSI, currently sitting around 77 and deep in overbought territory. And fifth, if you're holding this exposure through an ETF wrapper rather than the token itself, understand that you are layering custodial and structural risk on top of an already volatile asset. Self-custody removes one of those layers entirely. So here's the question I want you to genuinely sit with. Is this the smartest money on earth spotting a financial service juggernaut early, getting positioned before hype becomes core institutional infrastructure? Or are Goldman, A16Z, the ETF buyers, and a leveraged NASDAQ treasury company all crowding through the same door right before insiders walk $714 million worth of tokens straight out the other side? Smart money or exit liquidity? Because right now, both stories are using the exact same evidence. Please get genuinely opinionated in the comments below, because which side of this you believe decides whether you're early or whether you're the one holding the bag. And if you want to understand exactly how these MicroStrategy style treasury vehicles can flip from a structural bid into a forced seller when the premium collapses, then check out our full breakdown of that reflexivity trap right over here. Thank you all so much for watching, and I'll see you again very soon. This is Lewis, signing off.